Alright, this is the RO1 module, Chapter 1. We will discover what the essential functions of a financial industry are and how they play a role within the wider economy. Then we'll see what the impact of the EU is on our local regulation here in the UK. We will identify the key participants in the UK and international markets. And finally, we will discuss the role of government in regulation, taxation, economic policy, and social welfare. Let's get to it. So it is clear that the UK is an actor in a global economy. This means there are bodies like the EU, for example, which heavily influence the trajectory of our policies and regulations in our financial sector here in the UK. We must consider this. We've been part of the EU for a really long time, so we will unpack some of the effect they had on our regulation, but we will not consider post-Brexit regulatory landscape because it has not yet been determined. So first, let's see the 4 essential functions that the financial services perform in the wider economy. So the first one is to provide a vehicle through which savings are protected and channeled into capital management. What this means is, when you put your savings in a bank account, they are first of all protected. You can retrieve them at any time you want, and then the bank pulls all of the deposits together, which is what we call capital, and then manages this capital in various ways that we will get to know later on. The second function is to provide means by which you, the saver, can have ready access to your capital, and at the same time, someone who wants to borrow money for a long period of time can have access to it, and allows the bank or financial institution to take long-term positions and potentially generate great returns from doing that. The third function is to allow individuals and companies to insure against risk and at the same time provide the opportunity to people who want to assume this risk to do so in return for payment. This is pretty straightforward. We've all at a certain point in our time had to deal with insurance and you buy it from someone. So this is exactly the function that we're discussing here. And the fourth and final function is to allow investors to disperse their risk across a number of different investment products. This means that you as an investor are provided by the financial services industry a variety of products that allow you to diversify your portfolio and thereby reducing your risk. So now let's see some real life examples of the manifestation of these 4 functions we've just discussed now. Let's call the first function short-term savings. So banks and building societies came to exist primarily so that people are able to keep their money safe and readily accessible. So imagine how risky it would be to hold all your money in cash under the mattress at home. House burglaries would definitely be very popular and people would assume extra costs to safekeep and safeguard their cash. I'm reminded of the words of Milton Friedman, who famously said there's no free lunch. So what do banks get in exchange for keeping your money safe? That's exactly right. They loan it out in clever ways and turn profit on it. A lot of times, banks make enough profit to cover all their costs and still have some extra left. So what they do is they share some of that extra with their shareholders in the forms of dividends, and you, the account holder, by not charging you anything to look after your account. And also sometimes they offer you a savings account where you can get interest just by leaving your money in the account. So while banks are owned by shareholders, this means people who bought shares in the company, building societies are owned exclusively by their members. These are usually account holders. These entities are different from banks, and you can tell the difference just by reading the name. More specifically, this kind of bank evolved as a mutually owned organization with the sole purpose of lending to its members the monies to buy houses, and thereby developing the local society. Hence the name building society. There used to be hundreds of them around the UK, but nowadays only 43 of them remain. They can all be identified by their name, like Nationwide Building Society, Skipton Building Society, Yorkshire Building Society, and so on and so forth. These special member-owned banks have no shareholders, and that allows them to distribute more of the profit that they generate to their members in 2 ways. The first is they charge less interest on the loans for the mortgages. That means you can borrow money from them at usually cheaper rates than traditional commercial banks like HSBC or Halifax. And the second way they do that is by offering savings accounts with high interest rate. Focus point. The takeaway here is that the essential function of a bank and a building society is to take the money you deposit in your current account and lend it to people and businesses for a fee that we call interest. In other words, they turn short-term savings into long-term lending. The second function, let's call it government savings. What else can you do with your savings if you don't want to put them in a bank? You can actually loan them to the British government. Governments are not living beings. They have no money of their own, and in order to generate the money to be able to afford things like the NHS, the army, public schools, all these things that we enjoy, they need to borrow money. So one way of doing this is by offering private individuals like you and me what we call gilts. These are investment vehicles issued by the Debt Management Office, DMO, that we can buy in exchange for fixed interest payments. The payments are called coupons, and they are issued every 6 months. Gilts are also known as government bonds or treasuries elsewhere in the world. The gilts have a nominal or face value, which is the price you pay to acquire one, and they have a maturity date, which means you can buy a 5-year gilt, a 10-year or a 30-year one. When the gilt reaches the maturity date, the government gives you back the principal you paid, more or less, and you get to keep the coupons you received every 6 months while holding the gilt. There are some special kind of gilts that are linked to inflation, so you don't really lose money on those in real terms. Sweet deal, huh? There's another government institution that borrows on behalf of the government, much like the DMO, Debt Management Office. It's called NSNI, National Savings and Investment. You might know of them because they're famous for offering premium bonds. These are lottery-based savings. You can put between 25 and 50,000 pounds in one of these accounts, and every month you participate in a random draw with a chance of winning prizes that vary from 25 pounds to 1 million pounds. And the beauty of all of this is you get to keep any gains without paying taxes on them. Most people win nothing, unfortunately. That's how the math works. So read up on them carefully before you get your hopes up high. So to sum up, when you purchase a gilt, you get a coupon every 6 months, and once it reaches its maturity, you can redeem it for the full amount, more or less. However, with NSNI products, you don't get any coupon or any interest. What you get is the likelihood of winning something every month. Focus point. The takeaway here is that governments can use the savings of private individuals to fund its borrowing. The third function, let's call it insurance and risk management. Let's get the definition straight. The principle of insurance and risk management is simply to protect and safeguard assets from the financial effects of damage and loss. That's quite a mouthful. Let's break it down. When you break or lose your phone, there's a financial effect you've incurred in that you will have to pay money to repair it or have it replaced. Insurance comes in and protects you and your wallet from the financial effect of losing or breaking your phone in this case. So how do we insure against situations like the one I've just mentioned and others? Well, you either manage the circumstance like buying a phone cover, screen protector, that means you incur the cost, or the alternative is taking out a mobile phone insurance. If you found this principle exciting like I did, you must be wondering, what are the things I could possibly insure? And how on earth can an insurance company afford to pay out so much money from so little contribution? Think of it, your premiums are nothing compared to the amount that they pay you out. So let's answer these questions. The first one, what can I possibly insure? The answer is 4 things. Let's enumerate them. Physical assets, like your phone, your house, your car. You can insure earnings, so you can protect your salary in case you lose your job. You can insure profit potential, so you have a case where companies have a key worker, the CEO usually, has a vision for the company and helps them generate profit. If this person dies, they will likely lose potential profit. And fourth and last one is financial transactions. We will not get too deep into this one because it is complicated. It uses instruments called derivatives that act as insurance by paying you out in the event where things go contrary to your expectations. That's how they offset loss. And the answer to the second question, how do they afford to pay so much money from so little contribution? Insurance companies collect premiums. That means the monthly or yearly costs that you pay out. And what they do is, much like banks, they pool them together. But instead of loaning them, insurance companies invest this money in markets in the hopes of making greater returns and also being able to beat inflation, which eats at the value of the current money. I can hear you thinking, what happens if I want to insure against a situation that costs way more than the company itself? The solution to that is really clever. It's called reinsurance. In this case, the insurance company you went to assumes the risk, knowing very well that it's too much for it to shoulder alone. And then it goes immediately and buys insurance on that very insurance it just gave you, effectively splitting the risk across various institutions that buy parts of this risk. It's genius. Lloyds Bank is probably the best known insurer and reinsurer in the world. Focus point. The first takeaway here is that insurance companies pull together all the premiums and invest them to grow the money and beat inflation. The second takeaway is that there are 4 things you can insure. To name them again: physical assets, like your phone or car; earnings, like your salary; and profit potential, like the event of a CEO passing away. Finally, financial transactions through the use of derivatives. And then we get to the manifestation of the last of the 4 functions, which is long-term investment and capital markets. Capital markets is the fancy word for the place companies can raise capital without borrowing from a bank. That's it really. How do they raise capital, you say? They trade securities like bonds, stocks, and other long-term investments. These markets also enable individual investors like you and me, and most likely institutions like pensions and hedge funds, to invest in assets that provide the potential for real growth. Real growth usually means the total growth minus the effect of inflation, which is also called the increase in prices and life costs. So the need for real growth on the parts of investors, coupled with the need for companies to raise capital without borrowing from banks, gave rise to 2 financial instruments. The first one is shares. You might have heard this one. So, shares are the means by which private investors, like you and me, and financial institutions can buy ownership or a piece of a company. Say you buy 1 share of HSBC or Tesco, you can realistically expect a rise in the share value. That means you buy it for £3 and expect to sell it for £5 later on. And also a proportion of the profits in the form of dividends. When you own a piece of the company, sometimes you own a piece of the say in some of the key decisions that are presented in shareholder meetings. There's another element that is not in the book, but that comes with owning a share in a company. I call it perks. For example, if you own shares in airline companies, you might get discounts. These are things that come with owning a specific company that are unique. And the second financial instrument that you can buy in the capital markets are called fixed interest stocks. They're also called bonds in other places. Yes, we've said governments can issue bonds to fund their borrowing. But as it turns out, companies are able to do that too. The cool thing about companies borrowing from investors is that they usually pay higher interest than banks and governments. And this is due to the fact that companies go bust. In your lifetime, you might have heard of many companies disappearing. But it is not the same with governments. They are less likely to default than companies and corporations do. Focus point. As an individual, you're able to buy parts or entire businesses in what we call capital markets. You could also buy corporate debt, that is called fixed interest stocks or bonds, in the very same markets. An example of a capital market is the London Stock Exchange.